Hey guys, hope you are all having a good morning. It's been way too long since we last did a morning video. Honestly, the markets have been crazy and I have had so much to read through in order to keep up informative videos in the afternoons that I barely have had time to sit down and put together some morning videos. Regardless, here I am now, ready to talk about housing once again. We have seen how easily financial markets have been rattled with the recent comments by the Fed Chair Jerome Powell in regards to rate hikes. One thing that nobody is talking about, or at least not talked about nearly enough, is the impact that the recent changes have had on the housing market in general. Mortgage rate loans have been increasing, and we need to be asking the Fed how their tightening on policy will impact housing. I am going to try to keep this video as brief and smooth as possible, so be sure to pay attention. Also, I sound like a broken record, but come join my Discord. So many people have joined and we are all having fun and discussing all kinds of theories and analysis on meme stocks, the markets and everything in between. Seriously, it is a ton of fun and everyone seems to be having a good time, so quit playing games like my ex and come join us. Links will be in the video description and in a pinned comment. Before we start, let me quickly state that I am not a financial advisor, and that all content discussed in this channel is simply information gathered that I deem important for people to know, so that they can make informed decisions. All efforts are aimed to better understand the nature of the current market in anticipation of the greatest squeeze in financial history. Let's dive right in. So, I am going to treat this as if you are a newcomer. The Federal Reserve is going to be tightening up monetary policy as a means to deal with the inflation problem that they themselves caused. The changes they are going to implement need to be effective if they are to stop a recession from happening, and for the measures to be effective, the pace of the rate hikes which they plan on accelerating need to be aggressive. This has contributed to a 30 basis point increases in government bond yields in January in a major stock market sell-off which we have been enduring for the past 2 weeks. Major indexes are in correction territory and nobody is really sure if we are going to rally soon or if we are going to be retesting previously built support. The corporate media has all had eyes on the stock markets, telling you a crash is imminent and which stocks to buy now, but what they are not talking about at all are mortgage rates, which have also been greatly impacted. The typical 30-year fixed-rate home loan has increased from 3.1% to 3.6% by the end of last year. This would mark it as the highest level as has ever been since the pandemic began, and makes me wonder, what is the housing market going to look like when the Fed starts tightening monetary policy? Now, I am no housing market expert by any means, but I have looked through what some experts have been saying and the consensus at the beginning of this year was that the housing market was going to have a strong start but cool off as the year went by. In the 12 months that ended in November, the Case-Shiller Home Price Index rose by 12%, and even since March of 2020, the same index rose by 27%. It is clear as day to anyone with a working brain, common sense and knowledge of what is happening with corporate America buying up all the housing that we are in a housing bubble. But the media loves to reassure us every day that we are wrong in thinking we are in a bubble. They back this up mainly through some mental gymnastics where they try to angle the discussion about supply and demand in a way that cherry-picks and benefits their point of view while simultaneously ignoring all the remaining loopholes and voids in their rationale. That is what the media does best, so we must take it upon ourselves to look deeper with our own eyes. According to the National Association of Realtors, 1/3 of home buyers paid more than the listed price for a home last year. Funny enough, we also have statistical data that shows companies like BlackRock and Zillow spending billions of dollars and paying sometimes 20% above asking price for homes in middle-class neighborhoods as a way to build up their rental portfolios. New data coming from Redfin shows that on average, your typical home sold within 15 days, and more than 60% of all homes went off the market completely after 2 weeks. So we know the conditions of home ownership are becoming astronomically impossible for newer generations and even middle-aged people. Well, when we bring in the new variable of rising mortgages on top of the high home prices we see, homes are quite literally going to become unaffordable for the majority of people. Metrics for home price affordability, which were outlined by Bloomberg and the Bureau of Labor Statistics, show that the current home prices are elevated 7.5 times versus the historic average. Sadly enough, the ratio which showed monthly payment to income was below 40%, which is well below the peak levels which were around 60% during the mid-2000s. But this does not answer the main question, which is how high can mortgage rates increases when the Fed gets aggressive with their rate hikes, and will this become the final hit that will make housing unaffordable for potential buyers? There is no accurate answer at the moment, but based on the prognosis of the statistics we have, if the ratio were to approach and pass 50% of income, will become incredibly disproportionate to a normal income. This was not an alarming thing a month ago, when everyone in the media thought the Fed was going to be raising rates until mid-year in 2022, but as we now know, the Fed is looking to hike up rates a lot sooner than that, with all expectations now on March. If inflation remains high above 4%, the Fed's going to have to raise rates higher than currently expected, as much as 150 basis points, and even that is a conservative estimate. Now, taking this back to housing, you can expect mortgage rates to rise more than expected as well. Mortgage rates will easily pass 4% and could even go higher than 4.5%, which would be catastrophic for new home buyers. The Fed has created a little monster, a boogeyman, that is not only coming for tendies, it's coming for your house dreams. Let's dive a little deeper though, because you need to be well informed as to what is coming up. With all we have talked in mind, you might wonder what the Fed is doing to try to solve it. Well, let me be the one to tell you that the Fed, led by Jerome the Joke Powell, is quietly trying to move away from this topic, avoiding any talks or even the mere mention of it, but this will not last very long. You see, already analysts are putting numbers together, and questions about the housing market will be coming up very shortly. 762,000 homes were sold at an average price of $453,000 last year. When you look at the $40 billion a month in mortgage-backed securities, it makes it clear that the Fed created what would be equivalent of a new home market. The high interest rates are growing so quick that they are lifting mortgage rates, and a few quarter-point hikes will not be anywhere near close enough to cool down the housing market anymore. When I say in my afternoon videos that the Fed is late to fix any of the problems, I mean it. I said not in this Sunday's video, but the one before on January 24th that what we are going through is not a market crash, and part of the reasoning behind it is that the housing market is still not crashing, and this is why. Housing represents about 40% of the consumer price index, which means where housing goes, the overall economy will follow. Stocks are in correction, but they are most certainly not crashing. Just pull up a 5-year chart and the current dip we are looks almost insignificant. Housing is still not shaking, the bubble is only growing. With this sector, which accounts for 1/5 of the GDP, and because it's so closely tied with the stock market, it makes people who owns home have stock market exposure. This is why the Fed is trying to avoid the housing problem, because they know that they have no real answer but to admit that housing is indeed in a bubble, and once they acknowledge that, people are going to start thinking, and they will equate the stock market bubble with the housing bubble, which indeed there is a strong connection, and that if the stock market is indeed on shaky ground with experts left and right calling for a soon-to-be market crash, what does that say about housing as well? Investors and homeowners are in for a very ugly and rude awakening once they start putting these two together. One of my biggest pet peeves, which I hate myself for not driving enough, is that the housing market is so closely correlated to MOASS, because a market crash could very well send us to the moon, but a market crash needs the housing market to crash in order to happen. People in the stock communities often ignore the housing bubble, and you will see them even asking me why I am talking about housing market at all, when in reality it is really all part of the same basket. At the last meeting last week, Jerome Powell left investors and everyone else scratching their heads. He did not answer the hard questions and seemed to be avoiding conversations about important topics. In fact, we don't even know how many actual rate hikes will happen because he and the Fed do not want to talk about it, which how crazy is that? How can such an important event as rate hikes to stop inflation not be thoroughly discussed at all? How can this guy get away so easily with such irresponsible lack of accountability? Back to the main topic, capital has been grown and thrown into the housing market, so much so that the rate hikes are not going to stop the inflation and bubble growing. People cite supply chain issues or waning demand as affecting inflation overall, but the issue here is that even without these constraints, some experts actually see home prices growing over 9% for this year alone, which is absolutely crazy. To be as direct as I annoyingly can, yes, if you don't own a house already, and you don't become rich or inherit one, or else decide to move to a region where there is not a lot of growth, the chances of you owning a house drop to near zero for the sake of being politically correct, because frankly speaking, I would tell you face to face that you will not own a house ever, and the way rents are growing too, you better buy a minivan and get an inflatable bed for it too. Rents, so far this year, are lagging behind home prices, but should still rise by more than 5%, and many markets are actually estimating this rate to actually more than double, so depending on where you live, you can expect to pay more than 10% more for whatever apartment or condo you are renting. The Fed's hikes are going to have little effect in lowering home prices. In fact, they might just do the opposite. The reasons are that the central bank, led by Jerome Powell, staved off the recession we should have had in 2020. But this did not undo it, it merely delayed the recession to be something much worse at a later date. Nothing comes for free. Everything has a cost, and we are about to pay the highest price as a country for the lack of strong leadership by the Fed. Housing will continue to grow in price, the bubble growing more and more by the day. The main culprits behind this are Wall Street, who are buying every middle class and now even high lower class home available, starving people off of generational wealth and financial progress, while simultaneously ensuring new housing doesn't happen too quick, because the method to their success is to maintain low supply to raise prices as much as possible. The government looked away, Jerome Powell can't even answer questions, and the Fed overall set housing for the next big crash. Thank your government for their amazing management, and mostly, thank the Fed and Jerome Powell for leading us astray. I want to thank you all for making it to the end. I know I did come off a bit frustrated at the end, but honestly, I find no objective way by which I can address the circumstances that are happening when it seems everyone in charge of something is ensuring the worst outcome for us all. I hope to have inspired a couple of wrinkles in this video, and I really hope you take a moment to let me know in the comments if you enjoyed the video and what your thoughts are. Don't just click off. Do leave me a comment with your opinions as to the matter or as to whether you liked this type of video or not. For the love of tendies, join my Discord already, I promise you a good time in it. I have a Patreon link in the description as well as some one-time donation links for Cash App and PayPal. Thank you again for being a part of this channel. I will continue striving for better content. Hope you keep having a great day and I hope to see you later today on the recap video. Until then, keep on buying the dip into the moon.